Welcome back to Keys to Legacy, where we're talking about protecting and building generational wealth, one conversation at a time. I'm here again with my cousin Clark Menefee, a life insurance agent based out of Roseville, California. And today we're actually going to be talking about the difference between term and whole life policies. Right, Clark?
Yep. Yep.
Okay.
Yep.
So, can you describe just what's the main difference between the two?
Right. So the simplest way to think about it, cousin, is term life is like renting insurance. It's cheap and effective when you need it most, and whole life is like owning insurance. It's a little bit more expensive, but it lasts forever and it builds value. So the easiest way to explain it is term insurance is it lasts a specific period of time. That's where the quote unquote that term comes from. It's usually 10, 20, or 30 years. And how it works is if you pass away during the term, your beneficiaries get the payout. If the term ends, you're still alive, the policy expires. There's no savings or cash value component. Now, the benefits, what a lot of clients like about that is it's a much lower monthly cost. It's simple and easy to understand, and it's great for temporary needs, mortgage, kids, income replacement.
Gotcha.
The downside is, again, it ends in 10, 20, 30 years.
Okay. So
Yeah.
when it ends, and let's say, you haven't passed away and you want to get another term life policy,
Mhm.
that premium could be higher, right? Based
Yeah,
on your
because
age.
again, it's like, think about it. If you're 32 years old, right, and you get a term policy and it expires in 20 years, that policy is based on when you were 32. And if you want to re-up, you can do that, right? But it's going to be, the rates are going to be for 52-year-old at that time.
Gotcha. Okay.
Yeah.
Okay. So, and I know you mentioned that term life is going to be cheaper, right?
Mhm.
Because it's for a specific term.
Yeah.
Um, who would that be best for? Like, is there a specific individual that's best suited for as opposed to the whole life policy?
Yeah, that's a great question, Jackie. And, it's really best for young families, first-time homeowners, people with a mortgage, or anyone wanting maximum coverage at the lowest cost, right? So we tend to see a lot of first-time home buyers, purchase a term policy because, again, it's aligned with their mortgage, right?
Mhm.
If they're healthy, as an example, healthy, 30, someone in their 30 plus years old, they get a 20-year term policy. Let's say their mortgage is $500,000. You're looking at maybe a payment between $28 and $32 a month, right? And again, assuming that you're healthy,
Right.
no, medical conditions, right? So that's why they're so popular, right? It's just like people can get a lot of coverage that covers their mortgage for to protect the husband or the wife in case
Right.
whoever the higher income earner is.
Okay.
Yeah.
Okay. So then what about whole life policies?
Hmm.
Who would
Yeah.
that best be suited for? Would it be someone who can afford that higher premium, but then has that guarantee of that protection for their whole life?
Yeah, yeah. So let me answer that similar to how I answered for term. So, whole life policy, it lasts for your entire lifetime, as long as the premiums are paid. Part of the premium goes towards a cash value that grows over time. You can borrow against the policy while you're alive, pays out a death benefit no matter when you pass away. So, the upside is, it's a lifetime coverage. It can build cash value. It can be used as a long-term financial tool. The downside is, as you mentioned, Jackie, it's a much higher premiums. So, that's best for, high income earners, estate planning, or people who want insurance plus, insurance that has a savings component as well.
Gotcha. Okay, so you mentioned the savings component.
Mhm.
Um, so do all whole life policies have that? And
Yeah. Yeah.
being that like that cash value
Yeah, they do.
accumulation?
Right. The only
Okay.
difference is there's some policies, it's dependent upon, what the growth component or the cash accumulation is tied to. So just your typical whole life, policy, they're all tied to like safe dividends. You can get, you'll get anywhere from 3 to 4% guaranteed, throughout the course, right? It's very low, doesn't go up high. And as we talked about, there's some other policies that have, higher rate of return for cash
Mhm.
value, but that's a topic for a different a different time.
Gotcha. Gotcha. Okay. Okay. Yep. We'll be getting into that too.
Yeah.
Um, So I know you talked about the cash accumulation in the whole life policy.
Hmm.
And I know in one of our next episodes, we're going to be talking about how someone can utilize that
Hmm.
in order to get themselves out of debt.
Yes.
Right?
Yep,
Okay. So we're
absolutely.
going to save that. But
Yes.
for now, as far as the difference between term and whole life policies, like if someone just wants to talk to you just to kind of see what would be a better fit for them, get some different
Hmm.
figures on what specific policies would cost for them.
Yeah. Yeah.
The best way to get a hold of you is to get basically to schedule a personal
Yeah,
one-on-one,
just
no
schedule it's a
obligation
yeah, it's a
consultation.
no obligation, consultation, Q&A, just talk
Mhm.
specifically about, your situation and, some possible options for you to consider, right? It's
Gotcha.
no pressure. That's what I do, right? Just educate, and through that education, you can decide, if that's something that's going to be, best suited for you and your family.
Okay. Okay. Well, I'm going to have all of your contact information in the comments, also a link so that they can just click that link and schedule some time on your calendar
Hmm.
just for a quick conversation, no obligation, no
Yep.
pressure,
Yep.
just so they can get the knowledge that they need to see
Yep.
what's going to work best for them.
That's it.
Okay. All
Yep.
right.
All right.
Well, thank you all for joining us on Keys to Legacy. Stay tuned for the next episode. Like and subscribe. We'll see you next time.
All right.